Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. It'll be related to three different topics. It's commodities, financial, and wealth building topics. That's generally what I cover. So let's dive in here. Let's see what's going on, and we'll get right to it. So if you want to follow me, it's at finding_finance. And if you want to join our community, it's finding-value.com. That's where I go over individual companies, individual stocks. You can see my portfolio. If you need help with any sort of commodity related stuff, or even the markets, if you just want to learn the markets. So the Fed, US fiscal, we're going to pump assets as much as oil and year over year inflation will allow us to. And oh, have you seen these very flattering base effects we have on CPI? Yes, it's time for takeoff, in his opinion. China, wealth is the enemy of the state. Bintwit, long China. Kevin Bamber, I want to go through this. Would love someone who has dug into the details and actually tried to prove management and get answers to us to tell us how many pounds of uranium does Cameco likely need to buy in 2024 and 2025 to fulfill their crappy contract obligations. Can you imagine the feeling of the oops of Cameco on the phone to a fuel buyer trying to buy pounds at $108 a pound so they deliver into a fixed price of $45 a pound contract? By 50 plus million plus for shareholders' money for 1 million pounds they buy. I wonder if they're going to beg to borrow pounds from the EDF, etc., and dig a bigger hole. Like a trader that won't cover a short and let it get bigger or let it get better and bigger instead. Let's just sell more up here. Price will come back. Oops, must be tough to sleep at night, wondering what would happen if the price really goes nuts like I predicted it might, blow over $200 a pound. That will be just devastating to cash flow. Perhaps someone in the legal department should be working on updating the risks section of the MDA, outlining the true risk of this contract book and even consider how it could impact debt covenants. I have to wonder if they're going to tap the market to raise dough sometime soon to shore up the finances and have dry powder to buy pounds as needed. A major mining problem, if it happened, could be totally devastating. And I don't own Cameco, not necessarily because of this, but I knew the thing that I thought was the near term producers or the producers that are producing today could contract too early. And I went after the developers where I was somewhat protected, where they couldn't, I didn't think they were going to contract early. They'd be someone who would develop later, and it wouldn't allow them to contract as early. And I was hoping that maybe they could get contracts later with the price a lot higher. I wasn't aware that this could be a potential problem where if they have contracts in place at low prices, and if they can't produce the pounds themselves, they could get into a problem where they have to buy it from, the spot price, closer to the spot price, and lose money. That is a potential issue with what he's bringing up. Rick Rule on today's closing panel with Jay Martin said, speculating on some sub 100 and sub 10 million valuations. He likes things that are hated. Platinum, palladium, nickel, silver, and gold. Says uranium is no longer hated. So that's his opinion. If we get a uninversion of the yield curve, I think platinum group metals will do very well if it uninverts. If we stay inverted, I think uranium will continue to rip. I also think that oil and nat gas eventually will kill it too. So I own a mixture of everything. I own uranium. I own all of those that he's saying outside of nickel. I mean, yeah, I own nickel through the diversified miners, but I own more of the PGM side and very heavy exposure to energy as well. So, but he is true. Platinum, palladium, silver, and gold are definitely hated. Nickel's kind of still pulling back, but it depends on the market conditions. that are coming. And I do think that out in the future, I think we're going to see big moves in everything, all of these. I'm going to read Gary's thoughts here, very similar to my thoughts of this sector, but I'm just full of thoughts today. I see lots of traders rationalizing that the halving in Bitcoin is going to result in another huge leg up. These people are in denial. Folks, Bitcoin is a busted bubble. It's going to be years before it recovers and makes new highs, if ever. Take a step back and look at the big picture. We had all the signs of a massive bubble. Price stretched insanely far above the long-term mean, a series of warning shots that something was wrong in 2021 with the initial crash, followed by the double top. Every Tom, Dick, and Jane trading Bitcoin expected to get rich, even though they knew nothing about Bitcoin or about the markets for that matter. They just knew other people were getting rich and they wanted to get rich too. This is the chart of one of the Bitcoin miners. Most of the others look similar. Folks, this is what a busted bubble looks like. If Bitcoin was going to recover and go to a million or 100,000, the miners would already be sniffing it out and in much better condition than they are. At some point, you have to come out of the denial phase and start looking for the next big thing instead of living in the past and hoping for the return of a collapsed bubble. My opinion, the best odds for that will be in the metals market. We just need to finish a false move to get everyone on the wrong side of the boat first. That will be the fuel to power a breakout, crush the forces trying to keep gold suppressed. Note how similar this chart is to the NASDAQ chart from 2000. Now, this is the chart of looks like RIOT, RIOT, however you say it. It is down, and maybe this is what a busted bubble looks like in Gary's opinion. And the one thing I will say is that when I look at the chart for a lot of the crypto stuff, it does look like that crypto cycles through faster. Their cycles are much shorter. So maybe it can go back into a bubble again at a faster pace. I don't know. But in his opinion, this is a busted bubble and this is what it looks like. Very well could be. And I'll just say I'm going to wait and see. But that's his opinion. And I thought it was very interesting to read that. Middle coop on the uranium. If you study the cycle's last bull market, which was 2007, he thinks we're in the early stages of a bull market. Things could get a lot hotter, but take a lot longer, in his opinion. Could see panic among end users due to geopolitical conflicts. Yeah, I agree. The one thing I'll say with uranium is I don't want uranium to have a huge blow off move in a very short period of time where the equities can't really keep up with it. I want a nice, slow, steady grind. It doesn't have to be that slow, but a good pace grind. I want the equities to follow the price of uranium, and I think a slow grind will definitely do that. We need some of these guys to come on. We need the supply to basically kick up, and we need the supply to meet the demand at least. And hopefully that occurs at higher prices. I don't want to blow off top where we temporarily move to something else. I want nuclear to win in the end. I think it's stable. I think it's cheap. And I want nuclear because it's clean to actually be the solution. I'm not in it just to make money. I want nuclear to actually be the base load power that we get. Like I actually want it. And if we get this blow off move, what's going to occur is they're going to try to find different solutions, temporary solutions, to put in place of what nuclear may not be able to plug if we can't get the production up, the supply of uranium up. And my guess is that the biggest benefactor of uranium not making it would probably be natural gas. Natural gas right now is the swing producer, so we would probably peg natural gas. And then I think we'll see natural gas prices really take off as well. But I'd like to see nuclear take off. So I want the balance to not be so far out of balance where we have to put in other solutions, short-term solutions. Grady talking about gold here. It's a very big picture. We've seen the 1970s bull, the 2000s bull, and now started the final third bull within the present monetary system. He says 10 to 15,000 is next. The third bull move, which will kill the present global monetary system, is what he's got. And I agree. The first bull move after Nixon ended the gold standard in 71. Now, I think there's other things that are going to drive this. I think the price of energy is going to drive a huge move in the price of gold. In the 1970s, early 70s, we went into not just freely trading gold, but we also went into peak oil in 1970. I want to cover that real quick on the conditions that occurred there. So this is 1970 peak oil in the United States. I think that has a large impact on the price of gold even. And you can see we decline. A lot of people say that technology is going to save us. I don't think so, guys. Look at the conventional lower 48. You can see this decline, decline, decline. Technology has improved over this period, but it has not reversed the conventional lower 48 and has not reversed that to the upside. Neither has Alaska. Offshore's taken a little bit larger chunk as we've been drilling more and more in offshore. And you can see the majority of new oil is coming from tight oil. In fact, tight oil is estimated to be 69% of U.S. oil production in 2023. Alaska fading to zero. The majority of oil is coming from tight oil. And the majority of growth in the world has come from tight oil in America. So this is where the majority of growth came from 2008 to 2023 in the world. Now, if you look at some of these shales, this is from 2019. Some of the projections is a peak occurring in 2031. I think that the peak could occur maybe even earlier than that in the basically maybe even this year or 2025 or 2026 based off of some of these projections being wrong in here. The Bakken and Eagleford, I think, have already peaked and they're starting to go down. And some of these other ones, I think, will peak as well, depending on where you're looking and what you're and how you're measuring it. What some people say is that the last one that is able to grow is the Permian. This is what the Permian looks like. This is just the Permian. And you can see that we had flat decline rates, kind of the earlier drilling locations. And you can see that technology, I think, has improved and also the resource quality has degraded some. And you can see the decline rates are really fast. You can see they're almost vertical on the more recent wells that they're drilling. So they're getting a lot out of them quickly, but they're declining almost vertically. The decline rates are very fast, and it's very difficult to keep up production growing with decline rates that are moving vertically lower. You can even see almost a shoulder head, shoulder top here in 2023 of perhaps production. Maybe this is the top. Now, I don't know if it's the top. I don't think anyone knows what these shale plays are going to do if oil prices were to go to 150 or 200 a barrel. This could very well keep going up if they just drill nonstop, which I think will occur at some point. Either way, if we get a peak worldwide in oil production, that is analogous to the 70s peak that we saw and how gold price reacted to that 70s, the inflation coming into the system, the peaking of energy, the increase of gold price. I think that's what's going to come on a worldwide basis to gold. And I think it could really catch people off guard. Our currency systems, our bond markets, they're predicated off of a continual expansion at an exponential pace. Our GDP is linked to oil. The correlation between oil production and GDP is highly correlated at a very high R squared value. If we can't grow oil production, we are going to get stuck in our GDP. And if the currency's design is to continue to grow at exponential speeds and you can't grow your GDP, you're going to get a large mismatch and you're going to get massive inflation. I think that's what's coming. We can see it in the 10-year yield breaking its 40-year downtrend to the upside. And I think gold's going to be a huge benefactor, and silver and platinum and all those other ones, where the physical metals are going to get repriced way higher, way higher. So I do think it's an opportunity of a lifetime. I think the risk reward is really good there. And I think that's a spot to be looking. And I think this move is right. And I just gave you my opinion of what could potentially cause it. Coming down, so natural gas storage now only 99 billion cubic feet above the five-year average. I know we were getting sold off in nat gas recently, but I still think it's a huge opportunity for natural gas. And I want to go over a couple of things in natural gas, the ratios. So this is natural gas versus platinum. We are at very low levels. It's very cheap, and it looks like we're trying to like work our way on higher, moving forward in this weird looking pattern. But we also had this pattern occur from 1990, and then we broke out of it in 2009. And it looks like we're trying to move similarly in a bull market. Either way, we're very low in natural gas to platinum. We are at all-time lows, natural gas to gold, all-time lows. And you got to keep in mind, guys, when something is this cheap against all the other assets, people are going to switch and use it. So people are going to switch to natural gas and use it over other um, sectors or commodities. Natural gas for uranium, all-time lows. And again, this can get cheaper, but this is very cheap. Natural gas to crude oil, very cheap in relationship to the 1990s. It's below the entire 90s and 2000s, and we're basically at almost all-time lows. Natural gas to the copper, very cheap compared to history. Natural gas to Dow Jones, you can see we broke out of this falling wedge to the upside into a bull market, went into another bear market here, broke out, doing a retest right now, and this could easily rip to the upside at some point, especially with it being as cheap as it is. And if we have problems in other sectors, like let's say crude oil, we hit a peak in the Permian for oil. I think nat gas, we're going to burn the living crap out of it. And if we have problems with obtaining uranium to produce nuclear, we may burn more natural gas. And this, I'm looking at this from a long-term outlook. Natural gas versus palladium, super cheap. Natural gas versus Baltic Dry Index, very cheap. And let me look at natural gas versus Newcastle coal. I'm going to pull that up really, really quick. There's coal there, and then we'll do natural gas divided by Newcastle coal. And again, we are on the cheap end. So why would anybody want to burn coal if you can burn natural gas for this price? They're going to burn natural gas. They're not going to fire up a coal plant. They're going to be burning the natural gas. Coming on down, another one by North Star, edging ever closer towards a big move. If we take the 2011 data point into account, we still have a big red line to overcome. This is the price of gold. Gold is trending towards something big. So not only is Grady seeing something big, so is North Star, bad charts. They're also seeing something big. I am too. I think something big is coming. And in my opinion, if I were to guess what's going to drive it, I think it's going to be energy prices, just energy prices in general. Here's another one with natural gas. 95% confidence or 0% confidence. The EIA updated its NYMEX natural gas price outlook with a confidence interval between $2 and $10 million cubic feet, based on the option contracts out in 2025. The current price is at 260. There's seemingly an asymmetric skewness in the natural gas sector. And I just went over natural gas to show you how cheap it was against all the other assets. And we're real close to the $2, the bottom. And we've got up to 10 with a 95%, kind of that's the 95th percentile confidence level at the other end. I think we could actually get up there to 5, 6, 7, $8 with some degree of certainty if we get our inventory levels back down. There is a cold snap, another cold snap projected to come in February. We're getting closer to the 5-year average, and our power burn continues to go up in the summer for natural gas. And if natural gas is this cheap, I think people are going to be burning natural gas over everything else because of the economics of it. So I think there's actually a good shot to go up quite a bit in 2024 into 2025. I do. Coming down. And that's where I'm going to end it, guys. So that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. If you haven't, subscribe to the website if you're interested. Use the word discount coupon code. The next question and answer session will be Sunday at 5 p.m. All right, guys. We'll catch you later. This is Finding Value.